Alrighty. Good morning, everybody. Welcome to the Hurley Investments Trade Findings and Adjustments of November 14th, 2024. We are still in a post-election bullish period, although a couple of days here of pulling back just a little as our market touched the overbought line on the RSI. We did get the 25 basis point rate cut like we thought. Decent reaction off of that as well as the election. We talked about Micron. In fact, let's just look at what we've got here. Micron trying to hold on to the 50-day and the $100 price, and not quite doing that today. It might be more at 99. You can kind of see this line I'm drawing based on the other two bottoms that touched over here on the 31st of October and the 2nd of October. So we'd be at a triple bottom, which should suggest that we get a bounce, but if we don't, that's a pretty crappy sign, and our next stop is probably down there at 86-ish. We have our shares of Micron protected. I want to say they're at 105 or something, or 100. Just going off the top of my head, but let's see. Talked a little bit about Baidu. As far as the trade on Micron, you're just hopefully listen to some of my ideas there to make sure you've got a short side making up some of this downward movement that keeps you a little more safe, or you're going out way further in time on the long leap long call, where you have plenty of time for it to sort its issues out and continue up. We've got Baidu. Man, kind of crazy. All of this big buying over here in September and October, and just petered out, didn't it? I see no reason why we're not going to go down and test that 80-ish dollar bottom. We're not very far away. Could be a matter of days before we hit there and hit an oversold point. We never even got there the last two times. It bottomed out there. And the last time we did truly get oversold, way back in July, we had a big, huge bounce back that also petered out. So my thought would be, let's see if it gets down there, and if it ever gets oversold. This was oversold for like 2 weeks, a little over 2 weeks, where you're maybe biding your time and see when it bounces, but you're in a position to catch a bullish bounce, like a leap call something like that. Once it hits around 80, or it becomes oversold, because in all likelihood, it's likely to take a nice bounce up from that point, at which point you could take a quick profit and you're good to go. So that's a thought. I'm just going to put that as I'm kind of thinking of this kind of stuff, just looking at these charts and trying to think of ideas. Like I mentioned last time, Baidu, as a China stock, China is flooding their economy with cash to generate growth in their recession. So we'll wait for it to 80 and or over sold on the RSI to possibly buy a leap. Well, I'll just say a leap call. Waiting for a big bounce back to take a quick profit if that happens. So don't really need to go over what's happening in our market. That's kind of the same. Had some clients ask about income generating investments. Look at covered calls, just as a note, income generating. Why would you want to look at that right now? Obviously, the only reason you might look at this as opposed to a growth or stock picking type thing is simply that we're at all-time highs, and might be a decent idea at least to have one or two less volatile income generating things that can give you a little cash, as we are still in an interest rate environment where we have a decent amount of interest to be had. As interest rates go down, that's a bullish market for bonds and interest heavy stocks, things like that. Reason being is because when interest rates are coming down, premiums are going up. So even if you might not be getting even if over time you're getting less interest, your premium's value is going up. I'm not going to talk about buying bonds. You're automatically out 7% as you need a broker to sell you bonds, government bonds rather, specifically. And that just kind of sucks. So obviously I'm not interested in putting a large portion or a major portion into this type of strategy, but you're just looking at, you know, a corner or part of your portfolio that you might consider. So income generating investments. We got covered calls on stocks with high dividend yield. Some ideas there are VZ, which is Verizon. In fact, why don't I look at this? These phone service stocks typically just go. In fact, if this is Verizon, you can look at T-Mobile, TMUS. For a long time, they went sideways and they just keep going up after they acquired Sprint. Their yield is dividend. They're more in a growth pattern right now, so forget that. I'm wrong. Only making 1%, but they're growing. Back to Verizon. Dividend 6.52%. That's pretty darn good. Verizon, Ford typically does because they do finance. They have a finance division that loans out the cars, and they're estimated to increase their dividend to 70 cents from 60 cents. Well, they'll be giving out 6.24% interest, and right now, trailing 12 months, it's 5.36. Which I don't know why they're estimating up with, maybe that's something to do with what Ford has specifically said. They're increasing their dividend after, through COVID, and several years after they had froze their dividend. So I guess they're just getting it back into rotation. Not rotation, but back into offering. So those are my two stocks that I'd be looking at. And let's see, just pause my screen here. So I can look up Verizon. One. Okay. So I'm looking at Verizon, looking out about a month to December 13th, not quite a month. If it would load here. Be patient with me. Okay. So let's do some math. And I've been rambling on, guys, without asking questions. If you have any questions, just type them in as we go, and I can get to it. But it seems like everybody's anxiously engaged. All right, so this side is our calls. This is our option chain here. Out a month, and we went, let's say, let's just look at 20 cents right here. That's about the difference. 20 cents divided by $41 nearly gives us a 0.5%. What about why $41? Because if you bought it right now, you'd buy it for $41 a share. You'd buy 100 shares. 41 times 100, you're looking at $4,100 of an investment. And you do your math on that, and you increase by hundreds of shares based on your needs and desires and other options that I'm going to show you for an interest type bearing thing. You've got 42 strike calls. We'll go off of 45 cents divided by 41, and that gives you a full, just a slight over 1%. If you go right at the money, you bought it for 41, your strike is at 41, you'll get, I'll say 88 cents. That gives you 2.15% if you round up there on the tenths. If you're purely looking for income there, that's what I would probably look at right at the money there. It gives you 2.1% on top of your, let's go back to Verizon. On top of your 6.5% in a month, you're making 8% there. If you've got the timing correct on the dividend X date, you've got to have purchased the stock and held it before the dividend X date. And you're just going to look up that on Google, VZ dividend X date. Upcoming ex-dividend date, January 9th. So you'll at least need to purchase the stock by January 8th. That means it's way out to January. Interesting. They're talking about their strategy of selling it after they're just looking at buying it for the dividend. Why is it 1.2%? Because they're only looking at one dividend, which you need to be in for the whole year to get the whole 6%, obviously, because it's based on 6.5% for the whole year. So I guess I lied a little bit. I think I said 8%. That's if you continue to roll out those every month for a whole year. You get a 6.5, and actually you get more than 8% because you're doing 2%-ish a month, assuming nothing changes, which for a stock, you never assume it won't change, and you never move around and mess around, and the higher it goes, the lower your yield is. And you have earnings, they bomb on earnings, it falls down to $30 a share. These are all risks and the downside of this strategy. But that's what you're going to want to look at, and it's a similar thing for Ford. I'll let you guys look that up, but you just saw how I did the math and decided which one. And really your covered call is more than anything going to be a little bit of protection. You're looking to most likely get out of that before an earnings, but then you've got to figure out when the dividend is. Here we go, we have the dividend right here. And you need to do that. I've got it right here, October 10th. So we can just delete this bull crap. I don't know why they're not talking about October. Because that's obviously the next one. We already missed October. So anyways, January, getting ahead of myself. Yes, that other site makes sense. All right, that's one idea. That requires more attention. It's single stocks. Covered call helps protect a little bit. You can just roll through it and keep it on earnings. But that's also your risk you're taking. Or you can try to work around the dividend X date and a covered call expiration date to book the profit on the covered call and the dividend. That's an idea, and that's just something you are going to have to figure out. Other ideas we've got. I don't like mutual funds that try to give you an interest. Bonds, because they are so expensive. Their track record, pretty much every single darn one, just their track record indicates that they cost more than they ever make on interest, and it's just not even worth it. So we're looking at the stocks, we're looking at an ETF, which is not going to have those costs, and you're going to get a 6.3% interest rate on JEPI, J-E-P-I. You do have options. You could do a covered call type thing on that as well. More work on your part. Going to be a bit less risky than doing the one stock, as it's diversified over many different sectors and companies. No, diversification is not protection, but the options are there, and you could buy a put if you needed to, obviously, but that cuts into your interest if it if the put comes at a cost. Another one I found was they're doing real estate. They're at 5.55. What's the other one at? 6.36. This just looks more like real estate holdings, and probably own a bunch of apartments and office buildings, stuff like that is what I would assume. But haven't really looked into it more than finding this 5.55, and it's optionable, so there's that as well. Can roll those covered calls on that. Problems with all these are just going to be that they're variable, right? They're still like stock moving assets. Your beta on a Verizon's only 0.41, so it's less volatile than the market. 60% less. And 6.5, wanted to write that in. Ford was 5.37. You could certainly do all of these, depending on the cash you want to put to work here. Then there are certificates of deposit. You're going to go to your local credit union. For me, it's Mountain America. Certificate 4.5%. Best CD rates, bankrate.com. Gives you a list of different. This one's 4.1, 3.2, 4.5. America First, 4.7. They're all pretty much in the 4.5 range. Which, if that's the case, you don't do a CD and you just go here to Wealthfront and do the 4.5% on cash account. Zero account fees, no minimum, no maximum. To earn your 4.5%, up to 8 million in FDIC insurance. How do they get it 8 million and it's only 250,000? Well, you come down here and you look at their questions and answers, and they have it spread across sweep deposits up to 32 partner banks, each of its own with its own fully insured $250,000 limit at any given time. As a result, you get 32 times the FDIC insurance in a Wealthfront cash account than a regular bank. Pretty interesting. There's different ways to withdraw. You have a debit card. You can withdraw from ATM. They can reimburse you for an out-of-network ATM. I assume you could do when you check out at the gas station or somewhere else like that, you can get cash, withdraw cash that way when the checkout kiosk thing or whatever you'd call it asks you if you want more cash. All those kinds of things, and you link it to your brick and mortar bank account and transfer funds as you need to. But it's kind of hard to justify doing any CDs when you've got something like this. That isn't locked in for a year or 6 months like a CD. And comparing it even with these, yes, you can get 6.3 and 6.5, but those are variable assets that go up and down. A little more risk. Is it worth the risk to make 2% more? Maybe for part of your cash, maybe for the rest of it. Wealthfront with 4.5% makes a lot of sense. Just some thoughts, ideas for you guys to consider. For something that's going to give you a little cash. You're still better off with the growth of the stock market long term, which in a couple weeks you could make 4.5%, but also is variable and you could lose that, which is why you're looking further out in time and you're protecting stocks with puts. Stock ownership is protected with your put protection, and you're buying more shares over time when it falls, when your stocks fall, when they miss in earnings, and you're making more when it goes back up. Again, this is just another thing to look at and think about for you guys and for some folks that have been asking me thoughts. And you're going to have to decide how much you want to put in something like this, understanding that you're likely either not going to protect with puts at all on some of these that are optionable, or if you do, you're cutting into this percentage yield significantly if you do. Guys, I am done. Any thoughts or questions? Quiet bunch tonight, this morning rather. No, I'm not getting anything from this Wealthfront thing. It's just one that I've noticed. They're just trying to more assets of cash for people putting cash in their accounts so they can tell you to invest it in their brokerage, not invest it, but put your money into the brokerage account as well to buy stocks and such on their platform. So it's just kind of trying to attract more assets, more cash from you guys, but they're willing to pay a nice interest for it. And in fact, it was like 5.5% before the Fed started cutting rates. So got to keep in mind that rates are still going down, and you might not be getting 4.5 for over a year, which is where you might want to look at the argument for a CD where it's locking in 4.5% for the period that they're, or 4.95. This is 3 months. Okay, so maybe not. These are all 4.25 for a year, 4.6 for 6 months. That way you're locking it in. Insured by NCUA. You got to check out these scores. Don't chase every CD on a no name, who knows what they are, but just be smart. Do your research. This site kind of helps you. All right, guys, that's it. I'm still rambling. Don't see any questions. Thanks again for joining me this morning. And kind of a different webinar just to give you guys some thoughts and ideas. Take advantage of some somewhat higher interest rates while we've got them. And hopefully that doesn't communicate that you need to ditch the growth that should come from lowering interest rates and growth on stocks. It's going to make a lot more than any interest you're going to get from these. All right, guys, take care. Have a good one.